The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Oh, it's Monday morning and there is a vast amount already going on. So we're going to bring you as much as we can over the next 3 hours with Karen Cho and myself, Steve Sedgwick. You're watching Scorebox and these are your headlines. Well, there you go. Unicredit's deal spree continues. Potentially anyway. The CEO, Andrea Orcel, launching a takeover bid for Italian peer Banco BPM in a deal worth around 10 billion euros. President-elect Donald Trump taps hedge fund manager and billionaire Scott Bessent to head up the Treasury Department, ending weeks of speculation and triggering a rally in treasuries.
German Finance Minister Joerg Kukies says there is broad appetite within Berlin and the Bundesbank to reforming the country's debt break rules, but stresses expectations need to be grounded.
Many parties have said that they can see themselves doing it. The Social Democratic Party, the Green Party. So in that sense, it's definitely a possibility, but we have to be realistic.
COP29 negotiators strike a deal to provide financial support to developing countries, but critics say it doesn't go far enough.
And Goldman Sachs prepares to take a reported $900 million investment hit from its investment in Northvolt after the battery maker in Sweden files for Chapter 11 in the United States. A very warm welcome to the show. Unicredit has offered to buy Banco BPM in an all-share deal that values the prey at just over 10 billion euros, according to Reuters calculations. It's the latest development in CEO Andrea Orcel's quest for consolidation. The offer puts a 14.8% premium on the Italian lender's share price on November 6th and would see shareholders receive 0.175 new shares for each Banco BPM share. Unicredit says the offer is autonomous and independent from the investment in the share capital of Commerzbank.
German Finance Minister Joerg Kukies says he expects Unicredit to back away from a full takeover of Commerzbank. Kukies says he thinks the German government opposition to such a deal will ultimately discourage the Italian lender from moving ahead. Meanwhile, Unicredit CEO Andrea Orcel indicated that he's waiting until after the German election in February before deciding whether to make a full bid. A scale. Oh, it's coming through in both of these conversations, isn't it? Whether it's around Banco BPM or Commerzbank, that Unicredit and Andrea Orcel is going for a deal because he wants scale. You've been looking at the offer document this morning. We've seen page 4 in particular, the key part here where they talk about that the company itself, Unicredit, does not have significant scale here. They talk about some of the challenges that are cropping up in intense competitive pressure, uncertainties around the macroeconomic context, but also around margins and the need to improve operational efficiency. So I think on a number of different metrics here, Andrea Orcel is saying we need size, whether that's internally in the Italian banking system or whether it's cross-border, he intends to achieve it.
Yeah, and then there's a lot in there, as you say, in that offer document as well. Let's just take back a stage. This would not happen now. It would not happen now if the Commerzbank deal was going through. There's no doubt about it. You really only want to absorb one big rival at a time. 2, if you think that it's the compelling necessity commercially was there. They do not think necessarily that it's compelling to buy Banco BPM at this current price. They've looked at it 20 years ago. Alessandro Profumo looked at it a long time ago as well. They've looked at it in 2021. They've looked at it in 2022. They've looked at it in 2023. It comes back every single year. On every conference call, Andrea Orcel is always asked about domestic consolidation. And had the Germans shown a little bit of, for want of a better word, bit of ankle on this one as well, then maybe that one would have gone through. But the Germans have got what they wanted. They've got independence for Commerzbank, and good luck to you in Germany, because you've still got 1,300 banks there. You're still overbanked, and you're not going to get meaningful consolidation at this pace because the whole establishment is completely against it. So Orchel, it's not inconceivable can do both at the same time, but it seems less likely. So let's have a look at Commerzbank shares first thing this morning. The second point is this is not cheap as well. And the reason why they've walked away in 2021, in 2022, and 2023 is, well, sometimes it was leaked as well. And quite frankly, they didn't like the price. But what they do see is the need for consolidation in key areas such as Lombardy. What is Lombardy? Lombardy is the great engine of the north as well. Milan and what have you. It's where they will get far more scale. So it's quite a lucrative, attractive prize for Andrea Orchel.
Yeah, the point I want to pick up on too is what happens now with Commerzbank stock. Do you see investors immediately think that it's going to suggest a reversal from the interest from Andrea Orchel and from Unicredit? Or does this become just some sort of long-term investment that once you eventually get CMU, and we're hearing more and more about it, and banking union, that perhaps the appetite does pick up for cross-border activity? So is it a long-term bet and an early stake that has been raised here? The other point is around what sort of pushback or what sort of encouragement they will receive at home. If you think about the Italian approach to consolidation in an effort to clean up the Italian banking system, there's been a lot of encouragement for deal activity, quite different to the Spanish market where there's been quite a bit of opposition from the Spanish government about consolidation. Yeah. So at this point, is it now a tipping point where there's too much consolidation, or is it still welcome in the Italian market? That would be my question today.
Let's bring in another voice on this one. We've got a whole host of reads about broader issues, and we'll come to those next after. But I want to bring Nick Nelson, Head of Global Equities Strategy at Absolute Strategy. Hello, Nick. Well, you've heard our back-of-the-envelope calculations about this. This isn't one that we've struggled to talk about because it's one that we've known about for a long time. But what are your views on this?
Yes, look, I think it's exactly right. It's, again, the questions of is it the in-market mergers or is it the cross-border mergers? And I think the political situation is obviously at play here. You have, of course, the German election coming in towards the end of February. You'll have some shake-up there. And to wait and see what happens after that and how the political cards fall for Commerzbank makes sense. But as you were saying, Steve, I do think if you're taking on board a whatever 10 billion plus deal to absorb just the sort of sheer internal processes you have to go through, it would be surprising to do at the same time a very large cross-border deal.
Can I just, my point of view, and I'm a Germanophile, if it can be such a thing as well. I admire the strength of the German economy and the way that they've reinvented themselves many times over the last 80 years. But at the moment, I see this as not the sick man of Europe, not as a basket case, but I see it as stunningly challenged because of their attitude institutionally to a whole host of things, not least consolidation. And I just think this is just once again a great example of why they are losing the moniker of dynamism across Europe. It's going elsewhere. It's going to the Italian banking sector. It's going to other areas as well. They just look stuck in the mud.
Well, look, I think the consolidation, we need to see proper cross-border consolidation, right? This was what didn't happen post the GFC. We saw, the Eurozone debt crisis 2000, 2012. We were supposed to try and see things happening then, and it didn't ever happen. And this was an opportunity, and it looks like we may have passed us. Remember, President Macron talked a couple of months back about how he would be open for a foreign European bank to buy one of the bigger French banks.
Right.
So, it seems that there's some mixed messages coming from the politics.
And to your point, you talked about, before or after CMU. We've asked it a lot, haven't we? Yes. Do we go before or after CMU? Orchel ripped up the book and went before CMU. Yes. Who is resistant to CMU in Europe? Can we think of a nation? Can we think of a biggish nation who seems to be resistant to some of the attitudes? I can't think. Off the top of my head, I can't think of a big nation.
Might be somewhere around the core. I want to pick up on another point because to me, Andrea Orchel has taken the banking system and looked at it with fresh eyes. He's looking for value. And there was a report that came out about a month or so ago from Deutsche Bank talking about the value that was embedded in Banco BPM business, saying it was a business that was trying to navigate around interest rate sensitivity, which we know has become an issue for a lot of the banks, not just in Europe, elsewhere as well, that it had some ability to do that. Therefore, perhaps it was sitting on a little bit of value for shareholders as well. Talk to us about that value equation, because the approach to Unicredit was very similar, that Andrea Orchel saw value in this banking business as well.
And look, many of these banks are trading well below, 1 times price to book, particularly in Europe. Global banks as a whole are actually trading about 10 times forward earnings. So I think there is value in the sector as a whole.
And nobody's cared until recently.
Nobody's cared until recently, right? And I think the general view has been, why would you want to own banks when central banks are cutting rates? So there's downward pressure on net interest margins, and then therefore people are concerned. But actually, if you look at earnings revisions for the broader sector, they've been very robust. And these Q3 reports in Europe were actually amazingly European net income numbers year on year were slightly higher than the US, which surprises people. If you look at banks and financials, that was driving the positive beats here in Europe. So I think actually the sector's doing a bit better than people believe, and they're hanging on to their profitability on NIMs for longer than the analysts were expecting them to do.
There are certain commentators on this channel who have never believed for 1 minute that interest rates goes up means better profitability, interest rates go down means worse profitability. But that's just my view.
Yeah, it's a bit more complex.
It's a little bit more complex. But there you go. Right, let's move on. US President-elect, you're going to stay, by the way, to talk about things you were going to be booked to talk about. But thank you for talking about the banks. US President-elect Donald Trump has picked hedge fund investor and billionaire Scott Bessent as his choice to lead the US Treasury Department. The 62-year-old Wall Street financier, who once worked for George Soros, said his policy priority will be to deliver Trump's various tax cut pledges. He also advocated for a revival in manufacturing as well as energy independence. What does energy independence mean, ladies and gentlemen? I still wonder. Speaking with CNBC shortly after Trump was re-elected, Bessent had this to say about the impact of his pledged policies.
We're going to see deregulation, which is disinflationary. We are going to see President Trump has said he wants to get energy prices down, disinflationary, and then tariffs are a one-time price adjustment. The Federal Reserve, in their Teal book in the summer of 2017, said that the Fed should look through tariffs. And my view, and I don't have a say now yet, or maybe ever, but is that I would recommend that tariffs be layered in gradually, which would the price adjustment would be over a period of time.
Oh, that's music to the market's ears, isn't it? Layered in gradually on the tariffs. They love stuff like that. Trump also picked outgoing US Representative Lori Chavez de Reyma to head up the Labor Department before narrowly losing her seat. The Oregon Republican had received strong backing from unions in her district and is considered one of the most labor-friendly Republicans in Washington. Fascinating. Also in the mix for Trump's top team is Brooke Rollins, president of the America First Policy Institute, who has been tapped to be Agriculture Secretary. And the Washington Post reports that Stanford-trained physician Jay Bhattacharya, I have no idea, Bhattacharya, is favourite to become the next director of the National Institutes of Health. Karen.
Steve, let's take a look at some of the big market moves, in particular on the back of that move around Scott Bessent. The market just thinking this may be a nod towards potentially tackling some of the debt pile and the deficit situation. And you can see as a result, yields that had been marching north, peeling back and moving into the red, 4.34. So we pushed off the 4.4 handle on that long end of the curve. To US markets, and we did see another bounce again. Take a look at the trade for some of the dollar. Actually, we'll take a look at that first up. As a result, euro dollar, the bounce that we're seeing in euro and sterling moving us off the lows that we got to last week. So dollar is on the back foot thanks to that yield story. Now take a look at those markets, because we saw further gains across the course of the trading week. Friday's session just topping up on some of those levels. For the Dow in particular, 1% move to the upside, very strong as a result. 1.96, almost 2% higher for the trading week for the Dow. The S&P 500, the extent of the bounce about 1.7%. If you look at the big moving parts of this market, the components, telling you two stories. For the Dow, it was Home Depot to the upside, and that was on the back of earnings. We still had a lot of earnings reports from consumer companies last week, so that was a big narrative. But so too was still that Trump bump, the Trump effect on a couple of stocks and a couple of trades. So Tesla, the big moving stock to the upside for the S&P and for the Nasdaq. To the Asian markets, and what we're seeing on the boards for those markets, Australia modestly firmer. We're seeing losses out of the Hong Kong and Chinese markets. So again, more red ink on those particular boards, but stocks out of the Japanese stock market bouncing 1.4%. Steve.
Super, Karen. Right, Nick Nelson is head of global equities strategy at Absolute Strategy, in case we hadn't told you already. Nick, you're here to talk about all kinds of things. Look, the market's rallied. The market's rallied strong. It was back on again last week. The dollar remains in the ascendancy as well. I guess one could label a lot of this under the Trump trade. Is it the right to typify all this as part of the Trump trade, or is there something else going on as well?
Well, look, I think that the Trump trade is there in the sense of you're seeing the currency, seeing the dollar strengthen until the announcement of the Treasury Secretary. It's come off a little bit since then, as you were just saying, Steve, gradual layering on of tariffs, which I think the market was obviously encouraging to hear that. But you've also had this quite strong profit cycle. We have just had the Q3 numbers, US earnings almost double digit year on year, seeing earnings upgrades coming through.
Sorry, do we look at those US earnings ex Nvidia? Or
yeah,
because the double digits slightly skewed, isn't it?
Yeah, it is. But there's also, if you look at the Mag 7, they beat by about 11 percentage points. And if you look at the rest of the market, it was beating by about 7 or 8 percentage points. So it's not just, it's wrong to say it's just the tech. I mean, yes, you're right in terms of the magnitude of the growth, but this is broadening out, which has been our big call this year, that we'd see a broadening out.
Do you think we've got more meat on the bones, though, when it comes to the Trump's picks? Because all we had was him, and then we had the market moving fairly aggressively in a couple of trades. Do we get more colour at a sector level thanks to some of the names now being volunteered?
Yeah, I think we do. And I think, it is reassuring to see, Treasury Secretary who's obviously experienced finance guy. I think markets like that, safe pair of hands, as it were. And I think also that attitude from we're just hearing on the clip there about, how it's going to be slightly slow, maybe on the tariffs, or suggest to be slow. That's the sort of thing, markets are hoping as well. They're not hoping that after January 20th, after the inauguration, you suddenly have the 60% tariff on everything from China, the 10% tariff on everything else. And I think that process will be a little bit more complicated and more nuanced maybe than people might suggest.
There was a lot of deep dive into Scott Bessent and where he may take the US economy, a 3-3-3 approach, which is a little bit like the 3 arrows that we used to talk about with Abenomics, about growing the economy, trying to grow that economy and its revenues, therefore paying off some of the debts that the US has accumulated. How welcome would it be to see some of that debt pile tackled in a timely manner when the market has not cared so much about it, but feels like it's getting more anxious about growing debt from here?
Yeah, so I think clearly the US is running an incredibly large, fiscal deficit, 6-7% of GDP. The debt is building up as well. And this is at a time when they've got full employment, which is quite a strange point of the cycle to be running, such a big deficit. So these are starting to build. I don't think globally investors are concerned yet. I mean, this isn't the UK, right? This isn't like Liz's Truss's mini budget. It's the world's reserve currency. So it has these sort of advantages that obviously we in the UK don't. But nonetheless, I think people would like to see a debt coming under some management. And of course, you can grow nominal GDP to keep that ratio under control. And that's another way of looking at it, rather than just going down the route, as we were talking about Germany previously, which has been obviously very tight fiscal policies and the debt rate rule and those other things. So there's two ways of doing it. And yes, US debt to GDP is getting too high, but of course they can grow nominal GDP and take that ratio down.
European markets were mixed last week. It was okay-ish. I mean, the FTSE, for instance, rallied 2.5%, DAX up 0.6%, CAC was still underwater as well. So it made back a little bit of the ground that it's been losing. But do you see any reason to buy Europe on valuation grounds as opposed to buying US on growth grounds? Because the US is where it's at the moment. It's got that momentum. It's got the Trump trade. It's got the cyclicals. It's got the deep pool of liquidity. I'm talking myself into buying US equities here. And Europe's struggling on multiple fronts as well. Yeah. Do you see any reason to flip that trade? I know I keep hearing that we are at historically cheap multiples compared with the US, though.
I mean, there is value, definitely. Value has not been driving markets recently. It's been more about earnings momentum and price momentum, where Europe has been behind. I do think that the German elections in February will be interesting. Do we get some relaxation on some of the restrictions around fiscal? That could help support some growth. Those are factors that I think could be helpful. And again, it's all about profitability. And right now, we are seeing the US actually leading the way in terms of high returns on equity and high profitability.
Okay, Nick, lovely to see you. Thank you very much indeed for being so adept today and talking about banks as well. Much appreciated. Nick Nelson, Head of Global Equities Strategy at Absolute Strategy.
Coming up on the show, Netta has been speaking to European banking leaders at the EBC. We're going to bring you those conversations. Plus, we'll wrap up the latest from COP29 as negotiators strike a deal but face criticism on the world stage. Our conversation with the Ukrainian Environment Minister is just in over an hour's time. And we'll get a read on the labour outlook in Europe with Jonas Prising, the CEO and chairman of Manpower Group. That is a first on CNBC interview, 8:30 GMT. German Finance Minister Joerg Kukies has opened the door to reforming Germany's debt brake, telling CNBC's Annette Weisbach that Berlin is looking at how it can boost public sector investment while keeping to strict fiscal rules. Well, Annette joins us with more now. Annette, a couple of big themes, of course, what happens now with Commerzbank as we see this move from Unicredit, but of course the debt brake, which has been an ongoing issue after Christian Lindner effectively took aim at the debt brake the other week and decided it should stay, but everybody else wants it reformed.
It's a funny thing with the debt brake. If you ask Germans, like ordinary Germans, they all are fans of that debt brake because they think this is like saving, this is like preserving the value of their money. So the Bundesbank has done a very good job of making them afraid of inflation and too much debt. But having said that, if you look at what economic advisors are saying, also business leaders are saying, there needs to be reform to have investments in much needed spaces like infrastructure, education, schools, etc. PP. I could go on forever, I think. And that is why when I sat down with Joerg Kukies on Friday at that European Banking Congress, I did ask him whether he is actually in favor of reforming the debt brake, because the likelihood is actually not too slim that he is also going to be the next finance minister if we are going to see a grand coalition. So take a listen.
Beyond all of the controversy around the debt brake, we always have to remember that what German fiscal policy's solidity is all about is that in good times we build fiscal capacity that we can then use when times are not so good. And I think everyone in this country saw between 2020 and 2022-23, when we had sequentially the corona crisis and all of the detrimental effects of Russia's invasion of Ukraine, that the fiscal power that the debt brake forced us to build was actually very helpful in building and facilitating the fiscal response when we needed it. That does not mean that we don't need to reform the debt brake. And I do think that targeted, moderate reforms of the debt brake are possible. They are being broadly debated. Joachim Nagel is sitting in the front row. The Bundesbank has made some very interesting and thoughtful proposals on how the German debt brake can be reformed. Our Council of Economic Advisors has made some very thoughtful proposals, how we can combine the existing fiscal solidity with better incentives for public investments for the future.
So in case there will be a grand coalition for the next government and the CDU is also willing to modernize the debt brake, that's the message to the world, that we're willing to change things?
Yeah, I mean, I think it's in the public realm. Many parties have said that they can see themselves doing it. The Social Democratic Party, the Green Party. So in that sense, it's definitely a possibility, but we have to be realistic. Germany subjected itself, just like the other 26 member states, to European fiscal rules. So the leeway that we gain from reforms to the debt brake will always be subject to the rules of the European framework that we also, as good Europeans, have to abide by. And if you look at the numbers and the exact details of how much fiscal flexibility we have, we always have to be aware that the European fiscal rules also impose quite strong rules on fiscal solidity, which I think is very important to preserve financial stability in the long run.
So there's a Russian proverb, one should never give up hope. And probably that's the case also with the modernization of that debt brake. It could actually come with the next government. What it though needs is a 2/3 majority in parliament. And for that, the election outcome should not yield a 1/3 blocking minority of the populist party. So that's another threat to revolutionizing or modernizing the debt brake, because if there is a blocking minority of 1/3 from the populists, that could actually endanger the possibility to change, because it's enshrined in the constitution. So another topic, of course, was the ailing economy at that conference, especially because the PMIs on Friday were so disappointingly low, especially for France. And I did another panel with Villeroy de Gallo, the governor of the Banque de France, and of course the Bundesbank president Joachim Nagel. So I both asked them what they're now doing with that PMI and whether that makes them think actually about a larger rate cut in December. Take a listen.
If I had to sum up the cyclical situation of French economy, we have a quarterly growth, a trend of quarterly growth of about 0.2% each quarter, or more or less 1% each year. We will have 1.1% according to Banque de France this year, and we shouldn't be very far from this 1% next year, but we will publish in December. So again, we look at it, but we have other different sources which show more a continuity of the resilience trend.
Just to complement what François said, I think these PMI numbers, they were not a surprise to me. They are more or less confirming the overall picture that the German economy is stagnating this year, and the start next year will be complicated. It is for sure what the finance minister said a couple of minutes ago. There are cyclical reasons and there are structural reasons. I guess we have to address both. I think the whole picture is very complex, and this is not only one reason why we did this two gates, what we just read here. It's more about the structural reasons where we have to do so many things. But nevertheless, this picture gives us more or less the understanding that we have to speed up, we have to do what is necessary, otherwise the European economy is falling behind.
Yeah, do you also have to speed up cutting rates, and perhaps also by a larger chunk, because clearly the economy looks worse than expected?
I think I say what I'm saying over the last couple of 2 years. Because of the complexity of this picture, I will wait till we have our new projection that we will have for our December meeting. This meeting-to-meeting approach is the right way to do it. And it's not a big secret that, yes, over the next couple of maybe 12 months, or we will see maybe further rate cuts. But I do not speculate when a rate cut will come and how large it might be. But I guess the most important thing is here, and François said it, we are on the right track. We will bring back inflation to our target, and we will achieve that target latest by the mid of next year.
Even if the both central bankers wanted to avoid the topic whether 50 basis points is the right size of the rate cut for the upcoming December monetary policy meeting of the ECB, the market has already priced in at least a 50% or more than 50% probability that the next rate cut needs to be bigger than 25 basis points, given the dismal situation of the Eurozone economy and also the outlook for it. Because, of course, Trump means more tariffs, and Europe in a way is sitting in the middle between the United States and China. It will hit the Eurozone economy over proportionally, and probably it will also have at first disinflationary effects if there is no retaliatory measures from the Europeans. So it's a very uncertain mix, of course, for monetary policymakers, but I think the morale and the business atmosphere in Europe is much worse than in the United States. That was another topic at that conference. It's like a two-world thing, because here on the continent, people are very pessimistic, or rather pessimistic about the economy, about the outlook, whereas in the States, people tend to be much more optimistic. And also psychology, of course, is driving investments, and that is the main problem as well here on the ground, next to, of course, a lot of impediments coming from regulation, too less investment in infrastructure, etc., pp. So it remains to be seen whether the Europeans get finally their act together, but of course there's a huge question mark whether this is going to happen.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.